right, guys, let's quickly take a look at that Kiwi jobs data we've got coming up a little bit later. It's 12:45 SAST. That's going to be 11:45 UK time. So just keep that in mind, coming up a little bit later tonight. Now, in terms of this Kiwi jobs data, I think there's genuine two-sided risk for this. I think a big surprise miss and a big surprise beat could either way that could be tradable. The reason for that is, the recent data that we've had is pretty mixed. We had growth obviously surprising to the downside. Just before we had the most recent meeting coming up from the RBNZ, we had growth surprising to the downside. But at the same time, even though inflation didn't, surprise to the upside versus market expectations, inflation came in much higher than what the RBNZ had anticipated. So for example, if you take a look at this on the left and right, you'll see on the left we've got the statistical tables going back to their monetary policy report for February, which gives us their expectations for GDP and CPI. And then on the right hand side we had the actual CPI numbers. Now take a look at this. Growth was expected to be 0.3. We know already, looking at the data, that was a huge miss, right? Their quarterly growth number came in at negative 0.1%. Year over year came in at negative 0.3. So we already know growth came in with a pretty punchy miss compared to what they were anticipating or expecting. However, if you take a look at their expectations for inflation, even though, again, in line with market expectations, it was much higher than what the bank was looking for. The bank was looking for 0.4 and 3.8. They got 0.6 and 4%. Even more so, if you look at the underlying measures, inflation was still way too punchy for the bank here, but we'll get to that in a second. So mixed bag of data, growth to the downside, inflation still sticky. Where does that leave the bank? Well, pretty much nowhere, as you were, right? And that means from a rates point of view, getting a big enough miss or a big enough beat can be tradable because it should be enough to shift expectations across the curve, at least enough for us to get a trade. So keep in mind that let's start with a beat. Let's just say we get a big beat across the board, strong labor print. That's probably going to be enough to see the markets getting very close to pricing out a cut by the end of the year, right? We've got 34 basis points implied. If we get a really solid upside surprise in labor, that could be enough to see the markets getting that 34 down to maybe a 15, maybe even lower, getting us very close to a 50-50. Now, keep in mind, unlike most of the other banks that we have on this table, the RBNZ actually gives us data all the way up to the 2025, to July. So you can't look at these four. You have to compare all of these other banks to the RBNZ only up until that mid-range, that November meeting. That's the last one for the year. And there we can see 34 basis points is implied. So big upside surprise there could be enough to change that cut or getting very close to a 50-50. That should be tradable for the Kiwi. What about a big miss? If we get a huge miss across the board, look, the markets are not expecting a cut for August right now, but it's at 7, let's call it 8 basis points implied. If it's a huge enough miss, that could be enough to change that 68% probability to below 50 and potentially swap that hold for a cut. And that could be tradable as well. So I think there's two-way risks that we can look at for the Kiwi based on the data, based on market expectations. Having said that though, my preference for tomorrow, and it doesn't mean I won't short the Kiwi, it just means that I would prefer to see a beat. The reason is twofold. Firstly, positioning isn't everything, but it is important. And the currency, even though not massively stretched here compared to other currencies like the euro, for example, or the CAD or the Swiss, it is stretched enough to want me to be rather long than short, if that makes sense, right? So I would rather take a long in the Kiwi as opposed to a short. I would prefer a beat as opposed to a miss, but I'll take both. Again, just want to stress that. But I think a beat will be my preference. Apart from positioning, if you consider inflation, this bank, in my opinion, they are still on the wrong side of inflation here. Why do I say that? I mean, if you look at the chart, yes, they have made, let me just show you guys here. That's labor, where's CPI? If you look at CPI, yes, they've made massive strides back towards target, cutting inflation in half basically from 7.3 down to about 4. Now, even though they've made good strides, look at the data under the hood. The data under the hood not that one, this one, is still pretty problematic. You know, if you look at their sectoral factor model, which is a special core measure that they develop, that is still sitting at 4.3%. Now, tradable inflation, which is inflation which is more susceptible to foreign pricing, that dropped to 1.6. There you would say, oh, okay, well, foreign inflation doesn't really have so much of a bearing anymore in terms of that 4% number. But look at this non-tradable inflation. That's all domestic inflation pressures. That came in at 5.8. We slowed, but very slowly, right? Think about this. Last year in June, we barely moved from there. 6.6 down to 5.8. It's still incredibly high. And again, if you look at the non-tradable, look at this. Shows how domestic demand and supply conditions are affecting consumer prices. Wow. Okay. Nothing to do with the globe here. That's all domestic cost pressures. So I'm saying that I would trade a miss, but I would prefer a beat because positioning is stretched, and I do think that this bank is still way on the wrong side of inflation. Yeah. And something that I think would be more tradable or more attractive to trade if it's a massive beat. Now, what can we look for in terms of the numbers? Look, when we trade something like Kiwi Data, we normally we take it easy and we look for a move below and above, below the minimum and above the maximum. And that just keeps, it's easier to trade it that way. It's faster to know whether it's a big miss or a big beat. There is a couple of nuances as always. For example, if you take a look at the unemployment rate, even though a miss let's say a miss of 4.3 won't really be a big miss per se, because it's just above the consensus. If we get a 4.3, what makes anything above 4.2, well, really anything above 4% still bad on the one side, is that if you look at our unemployment rate, anything above that is a new cycle high for unemployment, which isn't great. But at the same time, even if we do print, as high as 4.4, we are still at some seriously historically low levels for the unemployment rate. So nuances, but again, we're not into nuances tomorrow when it comes to that. I think below 4%, going back, seeing a move lower in unemployment will be fantastic. And a move above 4.4 should be good enough for a miss, that is. Now, what about job growth? Well, in terms of job growth, the forecast distribution on this one is quite messy, and we've got a clear skew, or an outlier rather. If you look at the distribution, where is that? Here we go. If you look at the distribution, the minimum expectation we know is negative 0.2, maximum is sitting at 0.6, but look at the distribution. That negative 0.2, it's a lone wolf. Bank of America is looking for a super, super big miss. You can see that the consensus of 0.3 is much closer to 0.6 than it is to negative 0.2. So that is a little bit of an outlier. So maybe we don't even need to see a number below that. Maybe something just below 0 would be enough. So that'll put us more or less in the middle. So I think any type of contraction will be seen as a negative. It probably doesn't have to be below negative 0.2, but obviously if it is below that, it's going to be a big shock. And I think anything obviously above 0.6 will be a big surprise. So that should be enough on the job growth side. What about labor index or labor cost index? Very important to watch this as well. There, I think, again, need to keep it simple. Looking for a move below the minimum or above the maximum. Below the minimum as a miss, above the maximum as a beat. We can see prior for this was 3.9. Minimum at 3.7 and maximum at 4.2. Now, if you look at the chart here of the labor cost index, the challenge here with so let me just go back to that. The challenge here with anything below or 3.8 and 3.7 is anything below 3.9. Even if we just get 3.8, that is a new cycle low. So it's already bad. But we would prefer to see something even worse, right? We prefer to see something like below 3.7. Maybe 3.7 will do. And in terms of the maximum, even though above the max of 4.2 will be great, just above 3.9 will already show acceleration. So there's always those nuances to keep in mind. Obviously, below minimums and above maximums, that's going to be the biggest deviations, but in some of these we arguably don't need as big of a deviation, but the bigger we get them, the better. Also keep in mind that, you know, you'll be trading this during Asia Pac trading conditions, so you probably want a big enough deviation to make it worth your while trading during that time, because you do have bad slippage then. You know, you do have a lot of noise in the markets. You can get some pretty ugly fills. So you probably want to see as big of a deviation as you can get to really make it worth it. Now, what can we look to trade in the event of a big miss and in the event of a big beat? Let's start with the one that I'm least excited about trading. That is a miss. If we get a huge miss in the Kiwi data, what can we look to trade? The challenge here, guys, is there's really only two options, and both of them are looking pretty stretched here. The first one is a possible Aussie Kiwi upside. What makes Aussie Kiwi challenging here is, firstly, it's massively stretched at these levels. It is a mean reverting pair. We're basically at that 110 psychological level, which is quite stretched and punchy here for the Aussie Kiwi. The other thing making me a bit uncomfortable is the fact that copper prices are really decelerating here, which is a negative. It's more negative for the Aussie than it is the Kiwi. So that one could be possible because there is that obvious policy. Where are we now? Here we go. That obvious policy divergence between these two. But, you know, again, I'm not sure whether there's going to be much room to run to the upside here that'll make it attractive to trade. The other option is Euro Kiwi upside, because we had a real strong move in the Euro earlier today. The economic data has been improving as well. We are testing major levels of resistance here at that 181. So a nice pop above that could open up a nice bigger move or nice bigger run here to the upside. So that one could be an option. But again, just like the Aussie Kiwi, not as stretched, but we are trading this into key resistance on a move that has been pretty punchy compared to the recent price action that we've seen. But that's really the only options. What about something like a Kiwi versus a US dollar downside? Look, you can, but I don't know whether I want to trade the dollar that way going into tomorrow's risk events. It's not a horrible idea. It's just not my favorite one. So probably Euro Kiwi would be an option. Obviously, just keeping an eye on the Euro, whether we still have strength in the Euro at that time. Now, what about a beat, which I think will be the more attractive one to trade if we get a massive strong print coming out of that labor data? There, I think there's a couple of attractive opportunities. The first one that I was looking at last week was the Kiwi CAD. Now, I still like this to the upside. The one thing that just kind of is a bit of a concern for me for trading this specifically is positioning on the CAD is kind of stretched. Yeah, you know, this doesn't mean that it can't go lower. It just means, wow, you know, it needs to be such a beat, you know, to see that pair going much further. That makes me a little bit cautious on the Kiwi CAD. Not impossible to trade this one, just one that there is a bit of a risk that we need to keep in mind. The other one that I think could be really attractive here, for the same reason that we traded it lower a couple of weeks ago, is the Aussie Kiwi. You know, if we see a huge upside surprise in jobs, doesn't that just give us the perfect trigger for trading the Aussie Kiwi lower as a mean reversion trade? You know, why do we say mean reversion? Take a look at the dollar or the Aussie Kiwi on the daily chart. This is a very mean reverting pair. It has been so, in that case, you know, going back all the way to 2016. Very mean reverting pair. And the further we go away from that 108 psychological level, there's a lot of increased risk of mean reversion at these levels. Has there been good reason for that move higher? Absolutely. Do I think that move has been priced in? Absolutely. Right? I wouldn't be surprised to see a bit of mean reversion playing out for this. So if we get a good trigger like super hot jobs data, maybe that could be the trigger that we were hoping to get somewhere in this area. Remember, we traded this one lower purely based on market internals. There wasn't any specific fundamental trigger that we were looking at. It was market internals. Now, those market internals, by the way, they haven't let me just quickly grab that on the screen. Let me just Just give me a quick second, guys, to just show you where we are with those. Come on. Sorry, guys, let me just quickly grab that on the screen. So if you take a look at yield differentials, they haven't shown us the same amount of divergence that we had with our prior trade, but it does look, you know, at face value at least, that it has been getting a little bit stretched at these levels. Again, this isn't something, you're not going to base your entire trade on that. That was a good reason to trade it a couple of weeks ago, but we're not seeing that same divergence as strong as it was. Same story with growth differentials. It is actually moving in line with the pair now, but it does seem like maybe spot has just gotten a little bit ahead of itself. This in itself right now isn't something by itself that you can look to trade the Aussie Kiwi with. We don't have that same strong signals like we had a couple of weeks ago, but at least those signals are still there, just slightly, you know, a little bit more faded compared to what we had a couple of weeks ago. But bottom line is, you know, that could be a good reason to short this. The other reason is copper prices rolling over should be more negative for the Aussie than it is the Kiwi. So Aussie Kiwi, probably my preferred trade tomorrow if we get a nice big miss in, a nice big beat in that jobs data. Also keep in mind that, you know, if you're going to short this pair, shorting at that time of day or night is always much better than buying. Why? Because when you short, you get filled at the bid. When you buy, you get filled at the ask. Now, what happens with your spread is your spread spikes, right? So if you have a buy trade and your spread jumps all the way up to here, you're only going to get filled there. Where with a bid, you're going to get filled at the bid, or with a short, you're going to get filled at the bid. The only thing you need to do is you have to stay in the trade long enough for the spread to calm down and your ask price to come lower, which always gives you, in my opinion, gives you a slightly better, just a slightly better edge when trading these economic data points. So that's just a quick look then at that Kiwi jobs data. It could be a good trade. Like I said, my preference would be for a beat, but if we get a miss, it could still be tradable. It's not going to be as attractive as a beat.